NVIDIA, the second largest company in the world by market cap, just had a 10-for-1 stock split, and it's now selling for $118 per share. It's actually down 2% on the first day of trading since the stock split. Let's take a look at it right now to see what the right price for me would be for the stock and potentially how high this stock could go. So some high-level things on NVIDIA. $3 trillion market cap, $3 trillion enterprise value essentially means, Mo,
no debt.
No debt. That is incredible. Look at the growth of this company. The 5-year average free cash flow, Mo, is $12.5 billion. The 1-year free cash flow is $39 billion on revenue of $79 billion. That's basically 50% cash flow out of their revenue. That is incredible. Now, before you get excited about that growth, 76 times free cash flow, 70 times earnings. Guys, it's a $3 trillion company. $3 trillion. It is the second largest market cap, and it's selling for 70 times. Now, that could be justified. There's a lot of growth potential in this company. This company is selling chips like crazy. They are the leader in AI chip development. The clear leader. It's not even close right now. But the question you have to ask yourself is, if every investment is the present value of all future cash flows, is this multiple an appropriate multiple for the company or not? Look at this adorable dividend, $394 million. I can't even believe it says 0.01%. I thought it was just going to say 0.0% and still have a dividends paid here. I don't know why they do this.
Why do that?
This is absolutely useless. Absolutely useless. Gross profit, 75%. Yeah, Mo, do you remember what it was just last year? Early last year, it was like 60-some percent.
65, something
yeah,
like that?
something like that. Guys, to move your gross profit up 10 percentage points is an insane thing to do. That is so freaking unbelievable. The CEO of NVIDIA is a superstar right now. He's signing women's bras, which Dalton, our in-house analyst, said is it's going to be the sign of the top when you have a CEO of a company signing a woman's bra. But guys, let's keep this in perspective. $3 trillion market cap, $80 billion in revenue, $42 billion in net income. Let's just take a look. 38 times sales. Look at Microsoft, another $3 trillion company. 236 times revenue, $86 billion in net income, $70 billion in free cash flow. Now, what's the difference? Well, the growth potential. I think a lot of people argue that NVIDIA's growth potential is higher than Microsoft. Mo, what would you say to that?
I would agree with that.
Absolutely.
I mean, they're in a new space that is not really seen in the world yet, and Microsoft is not.
Right. And I think that NVIDIA has a lot more potential for competition with these high margins and so much excitement in AI. But NVIDIA definitely has more potential for growth than Microsoft does. And that's why the market is giving it a premium. But remember, we always say this, that in every big market run-up in history, people usually drive the price up way further than the expectations justify. And just like in a downturn, people drive the price down much further than justified based on the bad news. All right, Mo, let's talk about the sustainability of these revenue numbers. Go for it.
I mean, look at these jumps. Let's just go to 2020. $11 billion in revenue, 16.6, 26.9, 26.97, 60.92, and they're on pace, trailing 12 month of 80 basically.
Yeah, so the pace is much higher than 80.
And if you just look at 2015 was 4.68 billion.
You know, Mo, that's a very good question. Remember, when things are going well, people have a hard time remembering that there can be roadblocks and there can be hurdles. We are still in the infancy of the biggest growth in AI. Now, this reminds me a lot of the tech boom and the internet coming out. The internet changed the world, still continues to change the world. AI is being changed because of the original .com and tech bubble of 2000. And a lot of companies still made it. Look at Microsoft made it. Intel made it. Cisco, all these companies still made it. But the only one of those that's seen an all-time high since is Microsoft, right? Intel and Cisco have not.
Right. And I'm not saying at all that this is not going to make it.
Oh,
it's
no.
Just, what is it going to look like?
Well, remember also, Mo.
I mean, think about...
It's hard not to make it when you have no debt in the company and you generate tens of billions of dollars in free cash flow.
This company will be around. If they were gone in 20 years, I would actually be surprised.
Oh, absolutely surprised. Yeah. So the question we have to ask ourselves is, if it has great growth potential still, why wouldn't we just buy it? Well, let me give you an example here. And for those of you, you're probably going to giggle at this. Let's pull up Cisco, actually. Cisco's the better one because Cisco, back in 2000, there was articles, and you can Google this, Articles written about how it'd be the first $1 trillion company. It hit $500 billion market cap. This company's going to the moon. You're crazy if you don't have this in your portfolio. You're stupid. Guess what, guys? That was the all-time high. March 27, 2000, $82 a share.
And remember, what they were doing was as new as AI is at this current time.
It was the future. This
Right.
is it. Now, you might sit there and say, but guys, but Paul, Mo, you don't get it. The company's financials. Well, let's go back to 2000. Back in 2000, this company did $19 billion in revenue. They do $55 billion today. So what is that? Triple. Okay, well, maybe that's not enough. Let's go to the profit. $2.67 billion in profit. 12 today.
Oh my.
That's over 4 times more. Well, it's 4.5 times more profit. But yet the stock has not seen those highs. Why?
$250 a share.
Overpaying. And if I told you back when this happened, that the company, back when this bubble was occurring, that the company would have 3 times revenue and 4.5 times profit 25 years from now, would you have said to me, oh, this company's going to be down? And guess what, guys? It's not like it's selling for an insanely cheap number. It's 15 times free cash flow, 15 times earnings. I can understand if it was 4 times free cash flow, 4 times earnings, saying, well, yeah, but the multiple's a lot lower, et cetera. And even then, it just goes to show how much things can just change based on perception. Now, the CEO, Jensen Huang, when they asked him about the stock split, he said, I want to make it more affordable for our employees and for the retail investor. Basically, we want the hype to continue because, guys, that's all a stock split is. A stock split doesn't make the stock cheaper. It makes the price lower, but what are you getting behind it? If a company has 10 shares outstanding and you own 1, you own 10% of the company. If they do a 10-for-1 stock split, every 1 share you get another 9 shares. It takes those 10 shares to 100. But you had 1 share, you get an extra 9. Now you have 10. So you now own 10 shares out of 100. Spoiler alert, still 10% ownership. You've got no extra ownership in the company. All it is for people to be able to feel warm and fuzzy saying, I'm going to buy more shares. Because people like going to their brokerage account and seeing more shares in there as opposed to dollars. But you're watching this channel. So it probably means you're a little bit smarter than the average investor, probably a lot smarter. And your goal should be to understand what you're buying, not this ticker that keeps going up and down. As a prime example, remember, the market cap is $2.95 trillion and the stock is $118. Let's go look at Berkshire Hathaway. The market cap is $900 billion. So $3 trillion versus $900 billion. What is that difference? 2.22 times larger. Look at the stock price. 621,000. 621,000. That's 6,200 times, let's call it 6,000 times larger. But guess what? The market cap is lower on Berkshire Hathaway. That is your proof that stock price does not equal value. And I love the fact that you're watching this video and understanding that right now. So Mo, going back to your comment about sustainability, let's go to analyst estimates here.
Oh boy.
So earnings per share. Now, obviously this is not split adjusted quite yet, but it's at $12.66 per share for this last year, growing to $45 a share. It was a 10-for-1, so it's going to become $4.55. Big growth here, Mo.
Oh, it's big.
280% over last year, 100% in the next year, 30%, 15, 18, and then 1%. And this is according to analysts. Remember, if you're an analyst right now and you come out and say NVIDIA's overpriced, what's the market going to do to you?
Oh, they're going to kill you.
They're going to absolutely...
You're going to get fired.
You're going to get fired because analysts have the same rep in terms of the same fears and biases that we have. Now, I look at analysts and I like to look for guidance. And I don't think they're probably wrong. There's going to be a lot of growth here. The exact numbers, not necessarily. Let's go look at revenue growth. 120% increase in the last year, 90% next year, 30, 15, 17, 3. Guys, look at this. My Microsoft example, according to analysts, in 2029, they still haven't reached Microsoft's revenue from today.
Wow.
Yeah, isn't that incredible?
Yeah.
And Microsoft has 70% gross margins, not quite 75, but that's something to be very interested in hearing and seeing. I want you to understand that. Mo, go ahead.
Microsoft also has 70% gross margins, and they've had that for quite some time.
Yeah, they've been pretty consistent in the high 60s and 70%. Yeah, this is very new. And remember, guys, when there's a lot of gross margins somewhere, what's going to happen? Just like in cloud computing, a lot of competitors are going to enter People are dismissing that AMD and Intel can compete with NVIDIA. And I don't think they can right now, but just give it time. I'm not saying that's for sure going to happen, but when you see this hype and you're a company who's trying to buy from NVIDIA, let's say they say to you, hey, listen, we got a lot of backlog here. You're not going to get your chips for another X amount of time. And Intel and AMD go, yeah, we can give you the chips now, or we can give you the chips very soon, and it'll be 20% cheaper. What are you going to do as a company? What are you going to do? Listen, I'm just talking about hypothetical here. Is that going to happen? I don't know. But if I'm Intel and AMD, that's 100% what I'm thinking. How do we bring a chip to market that can be less expensive and fill a backlog that maybe NVIDIA might have? That's the key there. When stocks sell at these nosebleed levels, 70, 75 times earnings on such a big number, you got to ask yourself, what's bigger here, the story or reality? And I feel like this is the story. I don't think the story is to be dismissed. This story is incredible, but I want to remind you that even the best thing in the world you can overpay for. That's the big key. And when the price goes up and up and up, the story typically does not match the price. So what is the right price? Now remember, guys, these are my assumptions I'm making in NVIDIA. You can make your own assumption. That's why we have the tools here. You can go out there and talk to people you know about the stock. My guess is there aren't many people out there really making a rational conversation about an investment. And that's why we have our tools and our community. So if you're interested in joining those, click the link in the description below, join the community. We have a great 1-week trial offer. Go check it out. Mo, here are my assumptions over a 10-year period on the last time I did NVIDIA. My revenue growth assumptions, I did 10, 20, and 30%.
Wow.
That's a lot.
That's a lot.
Now, just to show people how much that is, based on 20% growth, 1.2 to the power of 10 for 10 years of growth, that would take NVIDIA's revenue to $495 billion in the next 10 years. Is it possible? Absolutely. Is it probable? That is the question. That's key here to understanding. Okay, profit margin. Man, this profit margin has been, can they sustain this 50% profit margin? I did 30, 40, and 50%. I have to assume profit margin is going to fall. I have to assume, guys, I actually think 40 is really high. Because I look at Intel during its heyday, it wasn't getting 40% margins. As more competitors get in, are they going to be able to support these margins? I'm still putting 40 in here.
Wow.
That's still the average they've done. Actually, they haven't even done that the last 10 years. But again, it's a different market right now. You have to ask yourself, is it sustainable? Now, what multiple? Now, this is where everybody thinks I'm crazy. Mo, I did 20, 25, and 30. What'd you do?
I did 16, 20, and 24.
I think yours is the right one. I was just trying to exaggerate it.
Yeah, of course.
I'm just trying to show this exaggeration. And guys, for my desired return, I only put in 9%. 9 or 10% is what the market's going to do because I want you to assign your margin of safety. The higher the amount you put in here, the margin of safety is there. Remember, if you just want to make 9 or 10% in a company, just go buy an ETF. That's what you'll make over long periods of time. So if you want to buy an individual company, make sure you put in margin of safety. And there's 3 other reasons you need to do that. 1, we're humans, we make mistakes. 2, valuation is an art. It is not a science. And 3, the future is unknown. We don't know what's going to happen. You need that margin of safety. So I hit the analyze button. Guys, even with these insane assumptions, $30 on the low side, $318 on the high, $103 in the middle. It's just too expensive for me. Guys, if you haven't watched our video on the full breakdown of the 10-to-1 stock split for NVIDIA, watch this next video. Thank you for your time.